Robinhood offers margin accounts that let you borrow money to invest. This leverages your buying power, potentially increasing returns but also amplifying losses. This feature is primarily for Robinhood Gold subscribers or users with $2,000 in equity. Borrowing is capped at 50% of your portfolio value for long positions and 25% for short positions. Note that margin is limited to U.S. users only. Margin accounts allow you to borrow funds against your portfolio. Deposit funds, meet equity requirements, and request a margin loan through the app. The borrowed funds are then used to purchase securities. For instance, with $10,000, you could borrow $5,000, investing a total of $15,000. Robinhood's margin interest rates range from 8.5% to 12% APR. These rates are calculated daily on the outstanding balance and compounded monthly. The rates are pegged to market benchmarks like the Fed funds rate and can fluctuate with economic conditions. Margin borrowing on Robinhood carries significant risks that can lead to substantial financial losses. One major risk is margin calls. If your portfolio value drops, you may need to deposit additional funds quickly or risk having your positions liquidated to cover the loan. This chart illustrates how margin requirements work, showing the difference between standard and portfolio margin for a covered call position. Liquidation can happen suddenly without notice if your account equity falls below the 25% maintenance requirement, potentially forcing the sale of assets at unfavorable prices. These tables demonstrate loan details with varying APR and LTV ratios, showing how collateral requirements and liquidation thresholds work in practice. Interest on borrowed funds continues to accrue daily, even if your investments are losing money, which can compound your financial challenges. Leverage magnifies both gains and losses, so market downturns can result in losses that exceed your initial investment, leading to significant financial strain. Margin borrowing has seen increased adoption, particularly among younger investors. However, regulatory scrutiny has led to platforms adopting AI tools for responsible leverage. Robinhood is exploring crypto margin, allowing borrowing against digital assets, aligning with trends in decentralized finance. The GameStop saga in 2021 demonstrated the dangers of margin borrowing. Retail investors used margin to buy shares, causing extreme volatility and widespread account liquidations when the platform faced trading halts and inadequate risk disclosures. Many individual investors have faced margin calls during market downturns. When portfolio values fall below maintenance requirements, investors must add funds quickly or face forced liquidation at a loss, often amplifying their financial strain. However, experienced investors can successfully use margin to amplify returns on diversified ETFs during bull markets. By borrowing to increase position sizes in rising markets, they can potentially achieve higher gains while maintaining disciplined risk management. Financial experts, including Suze Orman, warn that margin borrowing is essentially gambling with debt and unsuitable for inexperienced investors. Robinhood CEO Vlad Tenev emphasizes that it's a tool for the informed, not the impulsive. Users must be prepared to lose their entire investment. As of Q3 2025, Robinhood has 25 million users with margin access and $15 billion in outstanding loans, reflecting significant growth. However, 22% of margin trades result in losses exceeding 10%, with a 2.5% annual default rate. Most users are under 35, highlighting the appeal to younger investors. These statistics underscore the importance of education. The high percentage of significant losses shows that margin trading is not for everyone. Experts recommend starting with small amounts and using stop-loss orders to manage risk.